Welcome to Invest Giant. Learn, invest, build your net worth. Looking for the best EFTs for 2024? Well, you've come to the right place. Exchange-traded funds, or EFTs, have revolutionized the world of investment. They combine the diversification of mutual funds with the ease of trading individual stocks. This powerful mix offers a unique opportunity for investors to spread their risk, while also giving them a chance to capitalize on market trends. In today's discussion, we're going to focus on 7 specific EFTs that are shaping up as promising prospects for 2024. These include the Vanguard International High Dividend Yield ETF, VYMI, Invesco S&P 500 High Dividend Low Volatility ETF, SPHD, WisdomTree U.S. SmallCap Dividend Fund, DS, FCF International Quality ETF, TTAI, Invesco High Yield Equity Dividend Achievers, ETF, PI, Schwab U.S. Dividend Equity ETF, SCHD, and the Fidelity High Dividend ETF, FDVV. Stay tuned as we delve into each one of these EFTs, discussing their unique advantages and potential drawbacks. Let's dive in. First off, let's take a look at the Vanguard International High Dividend Yield ETF, or VYMI. This fund provides access to a vast array of international stocks offering a broad geographic diversity. It's a great way to get exposure to markets outside of the United States, which can be a boon for those seeking to diversify their portfolio. What sets VYMI apart is its focus on high dividend yield. This makes it an attractive option for income-focused investors. It can serve as a steady stream of income, particularly in a low-interest rate environment. However, it's important to be aware of the potential risks. International investing comes with its own set of challenges, including currency fluctuations, political instability, and economic uncertainty. These factors can affect the fund's performance. Moreover, while high dividends are appealing, they can sometimes be a sign of a company in distress. Therefore, it's crucial to research each holding individually. VYMI is a solid choice for those looking for international exposure and high dividend yield, but keep in mind the potential risks. Next up is the Invesco S&P 500 High Dividend Low Volatility ETF, also known as SPHD. This fund stands out for its focus on low-volatility, high-dividend stocks listed on the S&P 500, making it a haven for investors who value stability. It's like getting the best of both worlds, the steady income of high dividends and the reduced risk of low-volatility stocks. However, every rose has its thorns. The downside to SPHD is that its growth potential might not be as high as some other funds. This is because companies that pay high dividends often have less capital to reinvest for growth. So while SPHD provides a consistent income stream, it may not significantly increase in value over time. In a nutshell, SPHD is a great choice for those seeking stability and consistent dividends, but it may not offer the highest growth potential. Now, let's move on to the WisdomTree U.S. SmallCap Dividend Fund, or DS. This ETF is an interesting choice for investors looking to tap into the potential of small-cap companies. These are companies with market capitalizations of under $2 billion, often considered the growth engines of the economy. The unique aspect of DES is that it targets small-cap stocks that pay dividends, thus offering a combination of growth and income potential. However, keep in mind that small-cap stocks tend to be more volatile than their larger counterparts. This is where the risk comes in. While these companies can grow rapidly, they can also tumble just as fast. DES is no exception to this rule. Furthermore, these dividends are not guaranteed. If a company's profits decline, it may cut or eliminate its dividend. In such a case, your investment in DES may not yield the expected returns. In conclusion, DES offers exposure to small-cap companies with high dividend potential, but it also comes with its own set of risks. Next, we have the FCF International Quality ETF, TTAI, and the Invesco High Yield Equity Dividend Achievers ETF, PIY. Diving straight into the FCF International Quality ETF, or TTAI. This ETF stands out due to its emphasis on quality. It focuses on companies with strong free cash flow, which is a key indicator of financial health and the ability to sustain and increase dividends. This focus on quality could be a significant advantage for investors seeking stability in their portfolio. However, there is a downside to consider. The focus on quality can sometimes lead to an overemphasis on certain sectors, potentially reducing the diversification benefits of an ETF. Now let's switch gears to the Invesco High Yield Equity Dividend Achievers ETF, or PIY. This ETF is all about high yield. It targets companies that have not just paid dividends, but increased them consistently over time. This approach can provide a steady stream of income for investors, particularly in lower interest rate environments. However, it's important to note that high yield can often come with high risk. Companies with high dividend yields may be more vulnerable to economic downturns, and there's always the risk that they may not be able to sustain their dividend payments in the future. So, how do these two ETFs stack up? Well, they both offer distinct advantages. TTAI's focus on quality and PY's emphasis on high yield can both be attractive depending on your investment goals. However, they also come with their own unique disadvantages. TTAI's sector concentration may limit diversification, while the high-yield focus of PEI can come with increased risk. Therefore, like with any investment decision, it's crucial that you consider your own financial goals, risk tolerance, and investment horizon before deciding if these ETFs are right for your portfolio. Both TTAI and PEI offer high yields and quality, but they also have their own unique risks. Finally, we have the Schwab U.S. Dividend Equity ETF, SCHD, and the Fidelity High Dividend ETF, FDVV. These two ETFs are well known for their high dividends and investments in U.S. equity, making them attractive to many investors. Let's kick things off with the Schwab U.S. Dividend Equity ETF, or SCHD. SCHD's primary advantage lies in its focus on the U.S., the world's largest economy. This ETF provides exposure to high dividend-yielding U.S. companies, allowing investors to reap the benefits of strong domestic performance. And with its low expense ratio, it's a cost-effective way to gain access to this market. However, it's important to remember that SCHD's focus on the U.S. also means it doesn't provide broad international exposure. So, if global diversification is a priority for you, you might want to consider other options. Moving on to the Fidelity High Dividend ETF, FDVV. FDVV stands out for its high dividend yield, a result of its focus on high dividend-paying sectors like utilities and consumer staples. This focus can provide a steady income stream for investors, even in volatile market conditions. But it's not all roses. It's worth noting that FDVV's narrow sector focus could potentially limit growth opportunities. Furthermore, the high dividends that make FDVV so appealing can sometimes be a sign of financial stress within the companies it invests in, so it's crucial to do your homework before diving in. To sum it all up, both SCHD and FDVV offer attractive high dividends and exposure to U.S. equity, yet they come with their own sets of risks. SCHD's U.S.-centric approach may limit global diversification, while FDVV's focus on high dividend sectors might limit growth and could possibly signal company financial stress. In the world of investing, there's no such thing as a free lunch. But with careful consideration and due diligence, SCHD and FDVV are solid choices for those seeking high dividends from U.S. equity, but always consider the potential risks. Balancing reward with risk is the name of the game, after all. Now that we have discussed each of these EFTs, it's time to wrap up. Over the past 10 minutes, we've taken a deep dive into 7 of the best EFTs for the year 2024, each with its own unique set of advantages and potential drawbacks. We kicked off with Vanguard International High Dividend Yield ETF, or VYMI, a fantastic option for those seeking international exposure and high dividends. Yet, it's essential to remember that this EFT comes with the inherent unpredictability of international markets. Next, we looked at the Invesco S&P 500 High Dividend Low Volatility ETF, which offers a balanced blend of high dividends and low volatility. This EFT is a solid choice for conservative investors, but it may not provide the high returns risk-takers might be after. The WisdomTree U.S. SmallCap Dividend Fund was our third stop, an EFT that's great for those wanting to invest in the small-cap market while earning dividends. However, the small-cap market can be volatile, so weigh this risk against the potential rewards. Then came the FCF International Quality ETF and the Invesco High Yield Equity Dividend Achievers ETF. Both of these EFTs provide a mix of high-quality international and domestic stocks, but they also come with their share of risks, which can include market volatility and changes in currency exchange rates. Finally, we explored the Schwab U.S. Dividend Equity ETF and the Fidelity High Dividend ETF. Both of these EFTs focus on high dividend yielding U.S. stocks, making them attractive for income-focused investors. Yet, as with any investment, there's always the risk of market downturns affecting these funds. So, there you have it, a quick recap of our journey through the best EFTs for 2024. Remember, each of these EFTs carries its own set of benefits and risks, and what works best will depend on your individual financial goals and risk tolerance. Investing in EFTs can be a great way to diversify your portfolio and increase your income, but always make sure to do your own research before making any investment decisions. Good luck with your investments in 2024. If you enjoyed this, leave a thumbs up and subscribe for investment insights. Happy investing!